So today we are going to talk about the fear gauge, Mark, which I thought would be a good rating for movies, maybe, whether they're scary or not. But we are talking about something that is a little bit scary, which is the volatility of the market these days. Earlier this week, stocks were falling. The Dow was down more than 200 points. The NASDAQ fell more than 1%. And right now, the Volatility Index is up more than 12%. So explain to me what the VIX, or the Volatility Index, is and what we're looking at.
Sure. The VIX is the market's expectation for volatility going forward. And historically, the reason why it's called the fear gauge is because the market starts to expect volatility increasing when markets are going down. So when the VIX is heading higher, usually the market's heading lower. And so there's a lot of fear starting to be built up in the marketplace. But interestingly enough, when we look at the VIX, we see it as a contrary indicator, which means when there's a lot of fear in the marketplace or when the VIX spikes, it's actually a pretty good buying opportunity, not what you would think it is.
Right. Okay. So when I'm looking at the screen here, then this isn't necessarily, it's going down. So it's not that volatile right now.
Correct. So if you look past the last 2 days, the VIX increased.
Right.
Which to us would say, oh, that might be a buy the dip type of moment because fear got into the marketplace. And sure enough, you look at it today and the market is rallying and the VIX is coming down lower. And so that's how it usually responds. And sometimes you just have to be patient with it. You don't know if it's today or tomorrow or a couple of days, but that's historically what happens.
To watch the VIX. All right.
Correct.
And now, Mark, we're going to talk about something else that I found really interesting. This, which I'm going to share right now, is from allstarcharts.com. So this, I've been told, is kind of a sign that maybe investors are expecting a little bit of choppiness. You can see here that the U.S. Treasuries, the yen, and gold, they all bottomed out. So investors are maybe feeling a little bit hesitant. So are you keeping an eye on securities here when we look at this? I mean, that trend across all three is kind of significant, right?
Yeah, definitely. So there's a measure, or a ratio that we look at. It's called a risk on and risk off ratio. And so when risk off investments start to outperform or start to increase in value, and those would be just what's on this chart, the Japanese yen, the long-term treasury bond, gold, when those start to head higher, yeah, it's usually a pretty good indication that investors are feeling a little bit of risk off. And that's okay. The market's rallied quite a bit really from last year, but even this year has had a really strong first part of this year. So it's okay for the market to take a little bit of a pause or some sideways action here going forward as we head into kind of the late spring into the summer months, which is consistent with seasonality going historically.
Yeah. Also, Risk On, not a bad name for a band. All right, Mark, thank you so much for your time. We appreciate it.
Great. Thanks, Erin.